And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's Tuesday, day after Veterans Day, all back to work, unfortunately. Fortunately, we're all back to work, so it's all good. It's all good. John Penn joining me this morning. Lots of stuff to get into, obviously. Markets are just on fire. They're doing fantastic here. We'll kind of get into a bit of a technical look here in just a moment on that. But outside of that, economic data is continuing to still come in. Earnings are now really kind of winding up. The only big report left is November the 20th. That's NVIDIA, so mark that on your calendar. That's the last big one. But for the most part, all S&P 500 earnings are in. Earnings overall, it was a good earnings season for the most part. Stocks have been rewarded nicely for beating earnings. A lot of companies that missed earnings beat up pretty bad. Yesterday, AbbVie was down about 12%. That was one of the bigger drags in the market yesterday. That was on a phase 2 trial of a schizophrenia drug that they have now stopped the trial. It wasn't providing the results they wanted, so they're going back to review that issue. But probably a bit of an overreaction in the stock price yesterday. But again, that's been a very big winner in our portfolio for a long time. But a setback yesterday. We'll probably be looking to add to that position at some point, but needs to kind of settle itself out yesterday. Coming up this week is, of course, CPI, PCE. So we've got a good bit of economic data that's probably going to be moving markets, with respect to what is the Fed going to do next? That's the big question. What's the Fed going to do? Markets are starting to tailor back Fed rate cut expectations for next year. They expect another rate cut in December of 25 basis points and then potentially a pause at the first meeting. I think it's late January, early February. So that's going to be interesting to see. So if inflation comes in a little bit hotter than expected, which would not be surprising here, economy's been doing really well. We could see inflation come up a little bit hotter. One of the issues that may kind of keep inflation suppressed a bit has been oil prices, which continue to kind of languish here. But car insurance has been going up a bit. We've seen some other areas of cost rising a bit here over the last couple of months. So that may bring in a little bit hotter print. So it'll be something that we're looking for on Wednesday. But again, we're also getting into a period of weak year-over-year comparisons where inflation readings were fairly low previously a year ago. So even at a 2% print, we'll see potentially inflation rise here a little bit. But as we move into next year, by April, if we continue to grow CPI at 0.2% every month, through April, we'll be at the Fed's target of 2%. So again, we'll just have a little uptick first, probably in November, December, January, and then it'll tailor off again. And that's just because of those year-over-year comparisons. Again, when we measure inflation, it's that year-over-year analysis. What was the reading a year ago? What is it today? Is that up or down? And that's how we get to the inflation number. So you got to be a little careful when you look at these inflation data numbers, and just remember that there's some mathematical adjustments that are going in there because of these year-over-year comparisons. So anyway, that's going to be kind of the big market mover over the next week, and then pretty much after that, we're going to start kind of winding things up for Thanksgiving. Traders are going to start leaving. Inmates will be running the asylum through the Thanksgiving holidays. Then, of course, we come back from Thanksgiving and we walk right into mutual fund distributions. And this is where mutual funds distribute all their capital gains, income, interest, et cetera, for the year. So mutual funds have to distribute their capital gains, their interest income, and there's some rules that they have to follow. But that's how you get your distribution. And this is why, and by the way, that's a good point. John, remind me to talk about mutual fund distributions this morning, because every year we get tons of emails about my mutual fund was down $1 today and the market was up. We'll explain why this morning. So, but that's a big thing coming up in the first 2 weeks of December. That tends to suppress the market a bit, and then you get your rally into year end. So again, expectations are for the markets to move higher into year end. Would not be surprised. Ed Yardini out yesterday talking about S&P 10,000 by 2030. Yes, I'm going to write an article on it. Just trust me. I'm getting there. All right, here's what you need. Here's what you need to know before the bell this morning. Market has been on fire over the last few days since the election. We came down, and of course, we touched the 50-day moving average, kind of held that support going into the actual election itself. And then, of course, post the election results, the markets have just taken off here over the last few days. We're getting pretty extended here. One of the things we'll talk about this morning is that investors are now more exuberant than we've seen them ever on record. And over the last few days in particular, we've seen just everything running. Meme stocks, most shorted stocks. We have some of the highest call options going on to Cathie Wood's ARK fund right now, which we haven't seen that in forever because it's been such a big underperformer. But everybody's betting on everything going up right now. So again, markets here, clear buy signal. So again, from a bullish perspective, everything is just fine. There's nothing really to worry about. But we are very rapidly getting back into pretty overbought conditions for the market. So again, just don't forget that yes, it's all exuberant right now. Markets will likely be higher into year end. But again, this just, you're going to get a pullback here of some sort. And again, not dramatically, but you can pull back to the 20-day moving average, which would take you back to about 5820 on the S&P 500, and we're currently at 6,000. So, you could have a decent 1.5% pullback here fairly easily, and that will get you set up for that year-end rally. But again, just because the markets are so kind of extremely overbought here, I would do a little bit of just kind of risk management if you need it. If you've got some trades that have just been going crazy lately, you've got big profits in them, all we're talking about is just take a little profit back in, all right? I mean, just don't be greedy, right? But markets are going to move higher into year end. But again, you can kind of just manage that risk accordingly as we head that way. But again, markets are they're at the top of their trend channels right now. Typically, when we see markets up this deviated from the 50-day moving average, you do get some type of corrective or consolidative action. Again, it's been a great trade since the election. We added exposure to our portfolios. It's been doing fine. But again, just kind of things have gotten a little bit too hot too fast here over the last few days, and that's at least something worth watching into. The other thing that's been rising very sharply here has been the dollar. U.S. dollar index has also been on fire really since the election. Going into the election, it started getting a bid, but since the election has just really kind of exploded here as optimism is building really kind of globally for investors about the outlook for the markets, the U.S. economy here, particularly economic policies, deregulation, tax cuts. That's all very beneficial for the dollar. That's been leading to a very sharp rise in the dollar here over the last few days. And again, we've talked about before, markets were hedging with gold for the dollar. And again, this is always the way it works, is that gold was hedging for a dollar risk, and they were also hedging for election risk. So post the election, that reversal trade is now underway. So you've now got gold getting sold off, money moving into the U.S. dollar, so they're swapping reserves and moving some of those reserves into more risk-based assets. So again, that's not really a surprising outcome from the election. And again, it's just markets and managers were overhedged going into the election. So the catch-up trade now is occurring post the election. But again, things are getting pretty far ahead of themselves on all fronts. So we're going to see probably a little bit of rebalancing here, a little bit of just volatility here over the next week or so as we head into the Thanksgiving holidays. Okay, that's what you need to know before the bell this morning. When we come back, we'll pick up with John Penn. We'll talk about those mutual fund distributions and what you need to know about that. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, let's talk a little bit about mutual funds here real quick. So I know a lot of people don't own mutual funds anymore, but you'll be surprised that a lot of people actually do.
There are a lot of folks that I see that still have, a lot of mutual fund holdings from other firms.
Exactly. Of course, the whole passive indexing thing is now, I posted a picture on Twitter yesterday, showing passive flows versus active flows. Mm-hmm. And my comment was, at this rate, eventually the market will just be one big giant ETF. There'll be no more individual stocks anymore. They're going to buy all their shares back, so there won't be any more stocks. It'll just be one ETF.
Just one common pool.
Exactly. But interestingly enough, so there are people that still own mutual funds. So if you own a mutual fund, and this happens with other assets as well that do distributions, but we get this question every year about come December. We get swamped with emails of people kind of freaking out over their mutual funds because they have a big drop in them. And it's like, I don't understand. The market was up today 0.5%. My mutual fund was down 1%. That's the distribution. Now, what'll happen is in a couple of days, if you do dividend if you reinvest your dividends, you'll get some new shares of the mutual fund in a couple of days. And so it'll balance itself back up. If you take your distributions in cash, then you will have a big cash deposit in your portfolio for the distribution from that mutual fund. So it'll balance itself out. But for a couple of days, while that gets settled out, you're going to have this variance in your portfolio. So this happens every year. Every year I get the same question, generally from the same people. So I explain it every year to the same people over and over again. But this happens every year, and that period is coming up. Those mutual funds distributions occur in the first 2 weeks of December. They actually start in November, but they really kind of a big bulk of them tend to show up right around the first couple of weeks of December. Markets typically sell off a little bit because of those distributions, because they have to liquidate assets to make those distributions. So that's all that's happening. Right. So just don't freak out.
Yeah. And something to pay attention to, especially if you're really investing in actively managed mutual funds where there's a lot of internal portfolio turnover. Mm-hmm. There's a lot of buying and selling going on in there. Sometimes I will see that folks will typically place those more actively managed mutual funds in their IRA.
Yeah. Right.
In their IRA, maybe their Roth IRA, because what you have to watch out for about this time of the year is, let's say you buy an actively managed mutual fund right now. You may have owned it for a week or two, but then all of a sudden that fund is going to distribute all the gains that fund, you can receive a capital gains distribution for the year, and you've only owned the fund for about 2 weeks. And there have been times where I get an email, we don't really use actively managed mutual funds in portfolios. Not saying that they're bad. You just have to watch out for when, if you buy it, you take a look at when has that fund typically distributed their capital gains in the past, because
he's expecting asset prices to go higher, and the bullish sentiment is just really kind of overwhelming. And that kind of brings me to this post yesterday, and this is what I said I was going to write an article about. But Ed Yardeni was out yesterday talking about his prediction for the S&P 500, and he expects this now to go to 10,000, and it's pretty much he just drew lines. At this point, we're going to go to 6,600 next year, 8,000 the year after that, and then 10,000 by 2030. And that's a very look, that's 7% a year growth, roughly, a little bit more. It's about 7.5. So again, it's not that not that outrageous, right? It's just you're talking about a market that's just going to keep going up at this trajectory. And what's interesting, and I wrote a follow-up tweet about this, is that Ed Yardeni in particular is always exuberantly bullish. And you can go back in history, and he's never predicted a bear market. He's always like, oh, the markets are just going to go off to the moon. And this is the way Wall Street is in general. In fact, if we go back to 1999, Jim Cramer was writing about 10 stocks for the next decade. We go to 2007, they were talking about Ralph Alcampora, which his nickname was Ralph Make You Poorer, because he never called a bear market. But and all during bear markets, he was like, buy stocks. But they're always predicting that markets just go on kind of forever. And so this is the way it was, previously, is every time we get into these ripping bull markets, which are fantastic, right? We love them. But they just expect that they will just trend forever. And then, of course, something's going to happen. It'll have to do with valuations at some point, but you're going to have a reversal. That's just the way markets work over time. And this goes back, go back to the 1960s. They just expected things to go off to the moon, and then you had 1974. So, we go through these periods, and just understand that when everybody is on one side of the boat, that's kind of when you need to pay a little bit more attention to the risk you're taking in your portfolio. And again, I'm not saying, look, this is going to be a good year. Next year will likely be a good year if, potentially, but there's a lot of risk. Some of the policies that Trump is talking about instituting next year, big cuts to government spending, big cuts to government employment, or government agencies rather. And there was a good point. I got an email from somebody talking about that. It's like, he wants to do government efficiency and really reduce. The problem is firing government employees are almost impossible. Under the rules of the government, you have to, if I want to terminate John's position at the FDA, I've got to give him a job somewhere else in government. So getting rid of employment is going to be very difficult. We'll see how this goes. But again, when you look at employment as a function, government employment has been making up the bulk of our employment growth over the last couple of years in particular. So we've had this big expansion in government employment, and that's been supporting a lot of the employment roles, the wages, those type of things. So there are risks from, while these policies that he wants to implement will be good long term, as we were talking about on the show previously, is that it's going to be very important to communicate and say, this is going to cause some short-term pain. You're not going to get out of this mess unscathed, right? You didn't get fat overnight. You're not going to get unfat by not exercising, right? You have to put in the work, right? And that's kind of where government is. It's going to be painful to get it back to where it needs to be, but this is going to get reflected in the markets ultimately.
There's not a pill I can just take overnight and I wake up and I'm skinny.
Dude, they are working on it. I'll tell you what.
There's a pill for everything. Come on.
There is. And I'm sure they're working on it. But again, I just, trying to predict a bull market that's just going to run indefinitely into the future. My point is, just be careful. There's so many things that are in flux right now going into next year. They're all positive in most cases, but there are negative side effects to economic growth, valuations, earnings, those type of issues. So,
I think it just comes down to expectations. When in looking at your post this morning, and you were talking about the consumer confidence and looking at that chart, I was actually a little bit surprised that was pre-election.
Yeah.
Because it was literally the day after the election where I started hearing from folks, and they're like, hey, maybe I can actually be a little bit more aggressive than what I thought. It's like it just changed like that overnight.
Yeah.
It's like, well, what changed? Why all of a sudden do you feel like you need to be a more aggressive investor here?
Exactly.
Right?
Absolutely. All right, when we come back, we'll pick up. Got a few things to get into. Client questions, comments this week. We'll get into those with John. Talking about should you ever do a 100% bond portfolio? Talk about that when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Did I tell you I got off good this year for Christmas?
How'd you swing that?
She told me what she wants for Christmas. I'm like, I am all in on this.
The Real Investment Show podcast.
A wet dry vac for our back porch.
Wow.
That's what she wants.
That is fantastic.
I know. I was like, yes, I can do this.
Same show, your schedule.
Hey, can I throw in some floor mats too for the car?
Let me tell you, she would be thrilled with that.
That's fantastic.
She is.
At realinvestmentadvice.com.
She's a geek. I love her to death. I'm getting off good this year.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So the big joke in my family is that my son Thomas, who is at A&M. He's a really good-looking kid. He's got the beard, blue eyes, well built. And his sister's always trying to pimp him out to all of his to all their girlfriends, right? And so he's starting a business for Thanksgiving. He's going to provide Thanksgiving packages for $75. He'll show up at Thanksgiving, with a girl and tell a cute story of how they met. He'll stay through dinner and then give the parents a hug on the way out. At $150, he'll help do the dishes. Kind of wear matching shirts, do cute photos. The $375 package will do family photos, help with decorations, show up early to help out with dinner. And then for $500, he'll actually do a proposal at Thanksgiving, which will get the parents off the girl's back, and then break up with her after Thanksgiving and make it look like his fault. So, if you're out there and need a Thanksgiving date, he's available apparently. So he's a genius.
That's quite a business idea. I wonder if there's a package in there where he wears the matching ugly Christmas sweater.
No,
to
that's
the family too.
that's the Christmas package.
That's the Christmas
That's
deal.
coming up.
Okay,
so
got
yeah, he's a starving college kid. He just needs to make some money. What this comes down to, right?
And if he shows, and free food, right?
Exactly.
Free,
Get to eat free.
You get to eat free.
Yeah. The problem is he's got to do it like 2 or 3 times on Thanksgiving Day, right? So. I haven't really told him. I haven't really explained to him yet just how this is going to work out. But
Sounds good on paper.
Yeah. So we'll see what happens. All right. So talking a little bit about kind of the markets. People are very exuberant right now, and it's interesting because everybody. Again, John was talking about this as well, but I'm getting the same thing. Is that I've had a lot of people I work with. They were like, I don't want to do anything before the election. And I warned them about this. I said, you can't wait until after the election because the move will be over before you can do anything. And of course, that's what turned out to happen is doing that. But everybody was very, very cautious going into the election. Now there's like, oh, well, I don't want to be cautious anymore. I'm all in on this. And, the problem is now you're just going to have to be patient and wait for a better opportunity to put capital to work. But one of the questions that, I get a lot, I do get, a lot of people that come in, I know you do too, John, and they're like, look, I just, with interest rates at, 4.25%, I just want 100% bonds and I don't have to worry about the principal. I'll just collect my income and it's all fine. But there's a big problem with that.
Yeah. I mean, then I think what folks are looking for too, I think somewhat what is behind that question is trying to find a way to invest your money where your principal isn't at risk and you can generate a stable, predictable return. And so they're like, well, let's look at a bond portfolio for that. But then they look at what the yield is right now and they go, well, but I can make more in the market.
Yeah.
Right. Or looking at that all bond portfolio, you have the risk of that money not fighting inflation or keeping up with inflation or just keeping up with just the cost of living to keep your lights on and keep food on the table. So I think there's some of that too. I think we're all kind of looking for a free lunch out there from an investment standpoint. And just over the last week, there were 3 different times. I had 3 different conversations where folks were saying, well, hey, I could look at a 100% bond portfolio. We could look at where Treasury rates are right now. But then the question was, well, is there a portfolio strategy that you have where I can invest in a portfolio strategy where I can earn 6, 7, maybe 8% a year in reliable income on a regular basis without having any fluctuation or risk in my principal? Oh, and by the way, I want to have full access to my principal. I want it to be fully liquid. Mm-hmm. And to me, that just doesn't exist, right? I mean, are those unrealistic expectations to try to get an income stream of 6 to 7, 8% a year without any risk of your principal?
Yeah, it's impossible.
Yeah.
I mean, there's risk to everything. So we've gone through this matrix before.
Yeah.
Which is that you can always you can have 2 of 3 things, but you can never have. There's no investment that gives you all 3 items, which is appreciation, safety, and liquidity. Right. So if I want appreciation, that's fine. I can buy stocks and I can have liquidity, but I have no safety. So it doesn't matter what asset you look at. You can only have 2. There's no asset that will give you all 3. You cannot have all 3 in any asset. So and when I say appreciation, that's also income. So bonds provide income, which is same as appreciation, sort of, but it's what you can, it's the income you get or the growth that you get. But bonds are, functionally, they're safe, but they're not liquid,
Right.
Because you have to, hold them till maturity. So again, it's just when you look at all these things, and this is the problem with the 100% bond portfolio too is that it doesn't adjust for inflation over time.
Right.
And it's great. I get 4.25% on $1 million stay, and this is always kind of the big fallacy you see on CNBC and other websites. They're like, oh well, if you'll do these things and you can get to $1 million, then you'll be set for retirement. Nah, not really, because $1 million back in 1980 is vastly different than $1 million today when you're talking about what it costs to live, right? So. The problem with 100% bonds is always the problem with inflation. Yeah, I can buy a 20-year bond paying 4.25%, and I'll get 4.25% on that $1 million for the next 20 years. The problem is that in 20 years, that $1 million is not going to be worth $1 million anymore because of inflation, right? So, this is why you have to have some exposure to your portfolio that provides growth and appreciation, and then you reinvest that capital into your income stream.
Right.
But there is no way to generate 6-7% with no risk. And I see this a lot. I got an email the other day. It's like, oh, I just buy preferreds because, they're paying me 6-7%. It's like, yeah, why don't you go take a look at those preferreds during 2008, right? Go take a look at preferreds during the banking crisis that we had in 2020, right? Those all took a big hit because those are very much related to credit risk. And they are equities at the end of the day, and they do have principal risk.
Yeah, and so sometimes and I had that very conversation several times over the last week as well, where folks are looking at higher dividend paying investment strategies, whether those are preferred stocks or now I'm getting a lot of questions around like options based exchange traded funds. Yeah. Where there's an ETF like SPY, I think it's this is not a recommendation whatsoever. It's just an example where this is designed to track the Standard & Poor's 500 index, but they're writing option strategies with there, so it's designed to provide a much higher rate of return or from a yield standpoint. Right. And the question is, well, why can't I just own this and earn some yield with it? Well, but how did this behave during times of market stress? And the problem is these are all relatively so new. There's not a lot of data to go back and see, well, how did this perform during times of market stress, or will the dividend yields be safe? Or to your point, let's say you buy a preferred. Let's say you buy a preferred for the higher dividend yield. And you say to yourself, well, I don't care what the price per share of this does. As long as the dividend's safe, I'm going to continue to hold this. Okay, well, will you? That's what you really need to ask yourself. Because you go back even to Q1 of 2020, when we were going into economic shutdown mode, you look at how preferreds or even kind of quote unquote dividend paying investments behaved. They acted very much like individual equities. I mean, high yield bonds, my goodness, it looked like it was almost like an equity position. So you say to yourself before you buy that, okay, I'm going to hold on to this no matter what, as long as the cash flow and the income is safe. But then all of a sudden you wake up and, hey, that position might be down 10, 15, 20%. Who knows, depending on the type of market environment that we're in. You got to ask yourself, are you really going to be willing to hold on to that? Right? Because emotionally, that might be tough for you to do. Right?
Right. Yeah, absolutely. And this is always the case, though, and this is something that's developed over the last 15 years because it has been such a long bull market.
Yes.
And really, it's been a long bull market with fairly low volatility. It had, we've had some bumps along the way, 20% drawdowns, 10% drawdowns, but it's been just a fairly steady rise over the course of the last 15 years. So people have gotten really complacent. And again, the returns, by the way, over the last 15 years have been abnormal because you've been popping out 12 to 15% rates of return on an annualized basis, which is 50% higher than the long-term average from 1900 to 2008. So you've got returns that are abnormally high for this period of time relative to long-term historical returns, and investors have gotten very complacent with that. They're like, oh, yeah, I'll just throw money in. I'll make 10% a year, 15% a year. It's great. Yeah, for now that's working. The problem becomes is the next cycle.
Yeah, I'm kind of getting some flashbacks a little bit to 1999, 2000 as of late. Not necessarily with the conversations that I'm having with the individuals and families that we work with, because we get very involved in plans and looking at what sort of hurdle rate do you need moving forward, and let's really take a look at how much risk do you really need to place in your portfolio. That's a much different conversation that we're having with the individuals and families that we serve. It's typically with folks maybe that are kind of looking for an advisor out there, or maybe who's not a client yet, and they're trying to get an idea of, what are some proper expectations from a portfolio standpoint, or just from a total return standpoint. And it just seems that, well, hey, the expectation is, hey, John, I should just be able to earn 15 to 20% a year without any risk. I was like, man, that'd be, we need to really talk a little bit here.
But there's a lot of high yield ETFs. There's a lot of high yield, equities out there. I mean, they're paying, oh, look, this equity has an 8% yield, a 10% yield. Yeah, they do. There's also a lot of risk to them principle wise. And again, this is the things people say, oh, I just bought it for the dividend. Well, that's all fine until you lose 50% of your value and the dividend gets cut. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So just talking a little bit about, look, things are never risk-free, right? And again, when I see so many people that kind of get into this, lulled into this state of complacency where, oh yeah, I'm just, I bought this item, whatever it is, and it's got a 12% yield to it, and it's, I'm just collecting the yield, and we get all tied up into that. And remember that yield is only a function of price. And that's very important to this. I mean, if I look at, if I own 100 shares of let me just put it this way. If I own 100 shares of a stock that pays $1 dividend a year, right? Or I can have 100 shares of a stock that pays a $3 dividend a year. The yields are are going to be, different, right? And because it's a function of the dollar dividend paid out versus the price. And we get caught up into this mathematical calculation of what the yield is. And a lot of times you need to go back and look at what's underlying that yield, because one of the things that goes on with with these yield structures is that the company's paying out $1, but the price was 100 and now it's 20. Right? And so now it has this huge yield on it. Well, you have to ask yourself, well, why is the stock price at 20 versus 100 and they're still paying it? And then the next question becomes can they keep paying that dividend? Right? And this is one of the other issues that kind of comes along. It's like, if there's financial trouble at the company, this is why you have to, if you're a yield investor, which is fine, there's nothing wrong with it, just make sure you can do some balance sheet analysis. Look at the PEG ratio, look at, the cash they have on their balance sheet. Can they make those dividend payments? Because if we get into a period of trouble within the markets, and we will, the first thing that gets cut with a company, so company has kind of options to stay in business, and which is their job, to stay in business. So the first thing they do, they lay off a lot of employees. If things are still tough cash flow wise, the next thing they're going to do is cut their dividends. And we see this repeatedly throughout history. During 2000 and during 2008, companies cut dividend payments by over 50%. So again, this is what I was saying before, is like, I own a company, it's great, it's 100, it pays me $1 dividend. I go into the financial downturn, stock goes from $100 to $50 and the company cuts the dividend. Now I've lost half my money and I have no dividend. So my whole thesis for buying and holding the stock for the yield is now completely gone. And this happens more regularly than you think. And we saw this even during the pandemic. During the shutdown, we saw a lot of companies cutting dividends during the pandemic. So just, the I bought it for the yield story is great as long as you don't have market risk. And so just make sure you can, and if you're a yield investor, which is completely fine, again, we run a dividend equity growth model, just make sure that you understand how to read a balance sheet, because that tells you all you need to know about whether or not that company can continue to pay that dividend over time or not.
Yeah, and it's a shame the way corporations kind of look at their dividends, because they'll cut their employees first, right?
Yep.
They're going to do everything they can to try to protect that cash flow for their investors. That's really where they're going to start. But I can't tell you how many times when a company finally has to cut their dividend and they make that announcement, not only is your dividend cut, but then typically the price per share of that company drops pretty dramatically, because then everybody else is bailing out of it at that time, because, well, if the dividend yield isn't safe, it doesn't make sense to hold on to this anyway. So it just becomes an even more volatile situation for you. So that's why, if you're building a portfolio around structuring some yield, again, to Lance's point, you want to look at, what are the underlying fundamentals? What's the cash flow? What's the sales? What's the revenue for this business? If we get into some rockier waters, what type of product does this business produce? Is it recession proof? Who knows? Are we going to get into a recession next year? We don't know yet. That's the big question I'm getting to, is, well, what should I be doing to position my portfolio right now for maybe the possible big one that's coming around the corner? Yeah. Right. So you got to look at this stuff and just kind of try to think ahead a little bit as you're structuring this. So that way it doesn't need to be so many times. There are folks that I visit with and they pick maybe 4 or 5 companies that pay a really high dividend yield, and that is, quote unquote, their portfolio. It's like getting in an elevator that only has maybe one cable on it. Mm-hmm. Do you want to have one cable, or do you want to have a couple extra cable there to keep you afloat if one of those cable breaks, right?
That's right. So, and look, there's a lot of, as again, like we were saying earlier, is that markets are very exuberant right now. Yeah. Investors are very optimistic about, things post the election, but there's a lot of risk going into next year. And what I mean by that is that policy has outcomes. And while policy can be good longer term, it can have short-term pain for the financial markets, for inflation, for a lot of things. And look, this is a really good point, right? So, we like bonds, right? We like treasury bonds because they are, again, treasury bond prices are a function ultimately of inflation, economic growth, and wages. Based on current trajectories and based on current economics, those trends are lower. However, if the Trump administration institutes a lot of policies, economic policies that are good for economic growth, they're good for wage growth, they're good for, overall prosperity, that's going to give people more money to spend. So again, one of the policies that is really interesting right now that Trump talked about yesterday or day before yesterday, I can't remember, but he said that he's going to go after credit card companies and he's going to cap credit card interest rates at 10% versus 25%, which should have been done a long time ago. 25% is usury. If I loan money to John at 25% and he fails to pay me back, I'm going to lose that case in court because I charged him a usurious rate on that money.
Yep.
Credit card companies have been getting away with this for decades, which, again, just nobody's challenged them. But if he does that, that's going to give people a lot more money to spend because all of a sudden that excess interest payment is going to be available. And they're not going to pay off their credit cards any faster. They're going to use the savings they're going to have to go spend that money. So there's policies that are going to come along that could stimulate more economic growth. And that's okay. That's going to bring up wage growth as you have more economic activity. That will increase inflation because people are spending more money. Now, we're not talking about inflation going to the moon. We're not talking about 1970s inflation. We don't have the environment for that. But we could see inflation stabilize at, 2.5% to 3% under stronger economic policies. As long as wages are growing at 3 to 3.5%, then inflation is going to stabilize at that level. So you're going to potentially get into a period of higher stabilized inflation, which would mean higher higher interest rates on bonds, somewhere, 3.5%. So we could see a period where we don't see interest rates go back towards, 1%, 1.5%. And when we see, and this is what we've talked about before on the show, is like when we get to the period that we can identify the terminal rate for bonds, then we'll have to figure out something different with portfolios, which will primarily be mostly equity and dividend driven at that point, rather than having a 60-40 bond portfolio. Your portfolio would be more like 80-20, and the 20% would be corporates versus treasuries. So, those are changes though that policies have to generate, and we'll see how these policies work out. But there's also a lot of risk that these policies in the short term will create an economic slowdown first, before you get to the growth side of it. So again, that's why right now the risk is more to the downside than there is to the upside momentarily.
Yeah, that's so. It seems like there's a lot of exuberance for equities as of late, but not so much on the bond side for all those reasons that you just mentioned.
Yep.
Especially folks that own some of the longer duration bonds in their portfolio, longer duration treasuries, because yields have ticked up here. As of late, so you're seeing some downward pressure in the prices of those long duration bonds. So I'm getting questions too around just the viability of those, and does it make sense to still have longer duration bonds in the portfolio? And so to your point, there could be a period of time here, where we get into a slower period of economic growth, a less inflationary environment, and then it kind of cycles through again, and then maybe we get into a more inflationary environment later down the road here, right? So I guess what I'm hearing from you, Lance, is it still makes sense to have exposure to bonds in the portfolio. So right now, necessarily, and I'm getting this too, hey, is a 60-40 allocation, is that dead? That's a headline that kind of or a narrative that kind of resurfaces every once in a while. And as of late, I've been getting that, hey, does it still make sense to have some sort of like a 60-40 type of portfolio, right?
Well, it does, because it lowers your volatility risk over time, right? And again, what's the one mistake that investors make more than anything else is they panic sell when things go wrong. So, then this is why we run, a 60-40, 80-20, 70-30, 30-70. We have all these different variations of a theme. We have portfolios that are 100% equity, right? So, again, it depends on your risk tolerance, depends on your ability to handle volatility, and that's all determined upon kind of what allocation you want, because if the goal is to lower your volatility risk so you don't make bad investing mistakes, or in a severe market downturn, you don't lose half your capital, if that's your goal, you want to have some bonds in your portfolio. If you don't care about that and you're all for just give me all the upside I can get with the market and I don't care about the risk, then be 100% equity. There's nothing wrong with that. And we have a model for that. And we have a model that has gold and bonds and cash, and it's called our all-weather portfolio. So it's your super defensive model for a world. If you're worried about the world blowing up, we got a model for you, right? So it just depends on what your allocation needs are.
That's right.
And you can build a portfolio for it. It's all about measuring risk. All right, that wraps up the show for today. Thanks a lot for joining us. We appreciate it. Get by the website, realinvestmentadvice.com. Follow me on Substack at Lance Roberts. We post all of our daily market commentary there for you as well. We started that about 3 weeks ago, just crossed our first 1,000 subscribers. So go join us over there on Substack as well. We appreciate it very much. Have a great day. We'll see you back here next time on The Real Investment Show.